Welcome to Subramani. Today I'm going to experiment with something which may not have been attempted by somebody else, at least not in the Indian context, not that I know. I'm going to take certain quotes of certain investors and try to explain what they mean by that, and so that you not only understand this but you also implement it in your life. Very many people can read what a Buffett says or what a Peter Lynch says, but it doesn't mean they read it, understand it and implement it. For example, very many people believe that Peter Lynch says, if you are consuming a product and you like the product, go and buy the share. No, it's not true. What he means is saying, if you like a product, you're consuming a product, if people around you are consuming a product, go and do research on that company. It doesn't say buy blindly. Then you would have ended up, I would have ended up with Jet Airways, with Kingfisher. I liked their service, definitely it was good, but I did not end up buying the shares. Right? I use Colgate toothpaste and I have Colgate toothpaste shares. There are some companies' products which I use for which shares I will not buy. There are some companies whose products I will not use but whose shares I will hold. I held ITC for an extremely long period of time. I sold it only 5-6 years ago. I think about 4.5-5 years ago, to be more precise, when I thought that enough of cancer spreading that I have done and I should not own the share. It's just your wake-up call, right? Saying I don't want to hold it. There's nothing right or wrong. I'm not being moralistic. I'm sure I have companies which are doing much worse than spreading cancer, right? I used to have Monsanto chemicals and I never liked the attitude of that company towards Indian farmers. So I sold off Monsanto chemicals. Of course, I made tremendous amount of money, but having sold off at one stage, I have no clue at what price it is trading today or what price ITC is trading today, right? It doesn't matter to me. I sold off because of a principle. That's different. So now, sorry, I digress, but now let us look at what Buffett's slightly longish saying, so I would want to read it out rather than talk from memory. So the quote starts. The logic is simple. If you are going to be a net buyer of stocks in the future, either directly with your own money or indirectly, which means you own ownership of a company which is repurchasing the shares, you are hurt when share prices go up. You benefit when they come down. Of course, he says you benefit when stocks swoon. Emotions, however, too often complicate the matter. Most people, including those who will be net buyers in the future, take comfort in seeing stock prices going up. These shareholders, beautifully said, जैसे कहते हैं गौर फरमाइए, these shareholders represent a commuter who rejoices after the price of oil has gone up because his tank is full. This is so beautiful. Just imagine what he says. In the event that you are very young, and which means anything less than 85, because you are still investing, if you are still investing because your income is higher than your expenses, so you actually don't want the market to go up, you actually want the market to go down. But look at the face of the television news readers, the commentators, the editors, all of them are very happy when the market goes up. And these are all young people, all definitely less than 40. So which means they've got another 20, 30, 40 years of investing which they will do, at least 25 years of investing that they will do. So why are you happy that you have filled in petrol for today? You're going to fill in petrol tomorrow. Should you be happy that prices are going up, or should you be happy that prices are going down? This is what Buffett asks you. But you cannot keep the euphoria away because your mood says, wow, I put 1 lakh, it has become 1,20,000. Or I put 1 crore, it become 1 crore 20 lakhs. So people are happy with what has happened. However, when you look at your grandfathering statement on 31st January, which is the cutoff date, you realize that almost all your funds are way below the 31st January prices. You are not making a profit in any of those shares, which means it's good. You've been buying since that day in 2018, so 2019, 2020, we've still not reached those prices, right? So that is something to be happy about. So so when prices go down, you should be happy, which means you are young, you're still investing, you will get more shares. Now, when you pick your mutual fund statement, it's a stupid statement, very poorly designed, and the design has not changed over the last 200 years. At least when the British left India, the same format was being used. So I have no reason to see why people don't give you a better statement. The statement should first say what are your goals and how much money have you invested and what has happened. Now instead of that, they give you an IRR and makes you concentrate on that. Now look at what Buffett is saying. Buffett is saying don't concentrate on what is the price going up. You should be concentrating on price going down, because you're still a net investor, right? And the financial media sentiment again doesn't help. It is exactly backward. When it goes up, they say, oh, market is booming and etc. etc. Market is booming, company is doing very well, fantastic quarterly results. It's a great time to be selling, not buying, right? The best has already happened. Maybe it's going to get better. That's a different thing. But I'm saying that is not the time to be buying. Perhaps not, right? So time to be buying is not seen from price. It has to be seen from the discounted cash flow, how the company is doing, what market share enhancement is happening, how much dividend they are paying, what is ROC or RONW, does it have a 15-year track record or a 10-year track record. I think Graham calls for a 20-year track record, right? Today maybe you can't find any company with 20-year track record and 15 quarters of rising EPS. I find it very difficult with that kind of a screen, right? So whether you're buying with fresh capital or the company in which you have invested is buying you should be happy when prices go down, not when the prices go up. I think this is very clear to everybody. I mean, this is exactly how you react when there is a sale, right? I walk into a mall and I find that if I pay for 2 shirts, I get 3 shirts free, and if I buy for 5 shirts, I get another 7 shirts free, or things like that. What do? Then you go and buy. Whereas in the equity market, when market comes down for whatever reasons, I mean, you hear rumors that a bank in Europe is being wound up or something like that. For whatever reasons, when the market goes down, you should be rejoicing and buying, and market goes up, you should rethink what you want to do. But ultimately remember that you are a net investor, and for a long period of time you are going to be a net investor. So if you are going to be an investor, rejoice when prices go down, like Buffett says, and implement it. When prices go down, go and buy the shares that you wanted to buy always. What is already there in your portfolio, go and enhance it, right? Look at the strategies which people like Naren and IPRU took in March. They were net buyers. They had money, they bought something, and they must have made a lot of money. So being calm when everybody else is running around with like a chicken with its head cut, don't do that kind of a thing. So be happy when prices go down, buy more. When prices go up, maybe it's a time to book a little bit of profits and put it away into an account which you will not touch till your retirement, right? Do those kind of strategies rather than saying, oh, prices have gone up, I can't buy. Don't do that. Yes, when prices go down, the mood will not be good, but that's a time when you should go back and see these kind of videos and say, okay, this is the time I should be investing. I did it this March. I do not know how I will react 10 years later or 20 years later, but this March I bought and I benefited by the move of buying when everybody else was panicking, right? Thank you.